Hey everyone, good morning. Welcome to this educational presentation of practical applications of order flow trading. And thanks for taking the time out of your Saturday morning to come join me today. My name is Michael Valtos, and if you're new to my presentations, I'm the president and founder of Order Flows Trading. And what it is, it's an educational company and it's also a software company. And today's presentation is going to be a little bit different than a lot of the webinars that you attend in the past, because I want to educate you so that you could take charge of your trading and, become a trader. One of the reasons why many traders fail is because, they don't know how to trade. They just think that they can blindly follow other people with their trading advice and, have a nice red light, green light system telling them where to buy or sell. And today you're in for a treat because I'm going to share with you, 5 solid methods of using order flow that you can apply to your trading tomorrow. So the first one is recognizing market transitions in supply and demand with the order flow delta, how to identify distribution and accumulation at tops and bottoms for low risk trades. What is stopping volume? I'll explain it and explain how to use it to your advantage. And I'm going to show you how to easily see price rejection to keep you in winning trades longer. And lastly, I'm going to show you how to use order flow to determine where a bar will often pull back to as soon as it opens. And if you stick around till the end, I'll give you a copy of my book, Trading Order Flow. It's a 150-page book. You'll receive the digital download. You won't receive an actual copy in the mail, but you'll receive a download that you can print up or save to your tablet or smartphone. So why order flow, right? As a trader, you have to deal with what's happening right now, right in front of you on the trading screen. And the best way to describe it is like looking at the Doppler radar, right? I live in Chicago and, I could look at the weather on a weather map, but I'm really concerned with what's happening right now. Is the storm right above me? Now, order flow specifically, the volume footprint chart takes all the price and volume data and logically organizes it in a chart format so the trader can see price and volume patterns other traders don't see. You can see how buy and sell orders are trading and impacting the market right now. And why is this important is because, there's a lot of people talk about different forms of order flow, like trading on a price ladder, the depth of market, and all you're looking at is people's intentions to trade. The market is 5 bid at 6, but there's 1,000 offered at 8. Like, oh my gosh, there's such a big offer there. Well, the market's only 5 bid at 6. You got to be concerned with what's right in front of you. How is the market reacting to 5 bid at 6? And I'm going to show you how to use the order flow to determine if the market will continue in its current direction. And basically, with order flow, you're going to have a better and more complete information than the majority of traders because they're only looking at the open, high, low, and close of bars. They're not looking at the volume that's going on right now. They're not looking at and not understanding how bars are forming and why the market is moving. And again, it's like looking at the farmer's almanac trying to predict the weather as opposed to looking at the Doppler radar and seeing what is right above you right now. So those of you that are new to order flow and new to one of my presentations, just a brief background on myself. I don't want to spend a lot of time, but I want you to understand where I'm coming from. My name is Michael Valtos, and I started in the early 90s on the CME floor as a runner with Dean Witter Reynolds. Back in those days when we had trading floors, that's the lowest level you can start at. But I realized if I want to get into trading, I have to start somewhere. And, I left a job that was paying me, when I was 21 years old, 22, paying me close to 35,000 back in the early 90s, which back then, when you're 21 years old, making more than your age, you're thinking you're living large. But I realized I had to quit that job and start at the bottom in the trading industry. And that's what I did. And eventually I left the trading floor and I went to the upstairs trading desk at Dean Witter when electronic trading started taking off. I was their Globex trader, me and a group of other traders. We had about a total 24-hour desk running, probably about 6 or 7 people each shift. All told, I spent about 3 years at Dean Witter, and that was a great experience because I got exposed to electronic trading at a time when it was just starting, right? That was the infancy. CME had Globex, CBOT had Project A, NYMEX, COMEX had the access system. Each exchange had their own trading system. It's not like now where you just connect to, basically the CME group owns all the exchanges, but now everything comes in via one pipe. Before you had to have different pipes for each exchange. After that, I left Dean Witter. I joined EDF Man in Chicago and the global macro trading desk. EDF Man is a big English trading firm. It's been around since the 1700s. They got their start trading sugar. They're big in commodities. After that, I spent 3 years at Commerzbank in Chicago. I was a licensed Eurex trader. I traded Bunds, Babel, Schatz, DAX, Euro stocks. This was in the late 90s. And this was a time when electronic trading was really starting to take off. We still had the floors, but Eurex was all electronic. It was like the first exchange that was purely electronic. And I spent 3 years there. I learned how, the importance of trading European 10-year notes against US 10-year notes, trading DAX and Euro stocks against E-minis and NASDAQ. And after that, I joined Cargill, which is the big American trading company. It's a privately held company. If it was public, it would probably be about the second or third largest company in the United States. They trade everything there. The whole supply chain. They account for about 30% of the agricultural exports to the United States, about also similar amount of meat exports. But they also trade oil involved in shipping. Probably about 25% of all the ships in the sea is leased to Cargill because they're big on shipping the commodities around the world. So I learned, the relationships with commodities and how it ties into more of, the whole global scheme of trading. And then after Cargill, I spent 8 years at JP Morgan as vice president of futures trading. Being from Chicago, I'm a futures guy. Okay. And I spent 8 years at JP Morgan on the trading desk. I wasn't sitting in some office, looking at spreadsheets, coming out, tapping the trader on the shoulder. So, you're exceeding your parameters, stop trading like that. No, I was there banging away at the keyboards for 8 years. Times I loved it, times I hated it, but it was great experience. After the birth of my first daughter, I was like, I can't take this anymore. I got no life because I was coming into the office at just before 6 a.m. and I was leaving about 5 p.m. So I was spending basically as much time, if not more, in the office than with my family. So I left. So I don't want to do this anymore. I was, 43 at the time. And I said, that's it. I walked away from a very successful institutional trading career and I just started trading for myself. Over time, about a year or two later, I started developing the order flows trader software. Now I was trading with order flow before, and I was using another company's software, but it was kind of basic, right? It was just a volume footprint chart. And at this time, I was writing my book also, with how I trade with order flow, what I look for in the order flow. And I said, why can't the software do this analysis for me? So I met with the programmer who already understood order flow. And I said, I want to take all this knowledge and put it into the chart so it can highlight to me areas of support, areas of resistance, areas of price rejection, areas of stopping volume, areas where market is being swept, and etc. And that's how the order flows trader software was born. Initially, I wanted to keep it just for myself because I didn't think there's going to be a big market for it. I didn't think other traders would be interested in it, because at that time, you know, back in the mid teens, 2013, 2014, order flow traders, eh, there was a very small group of them, right? People didn't really put much into the order flow, but over time, it's expanded as, information on order flow trading came out and people were interested in it. And that's how the order flows trader software was born as the order flow under orderflows.com. Now it runs on NinjaTrader 8. It's a retail platform, but let's be honest, we're all retail traders unless you're working for a bank. And if you're a bank, you got big resources, right? But for the majority of us, we need to trade on a retail platform, which is most of us trade with NinjaTrader. So the charts you see in this presentation are generated from the order flows trader, which runs on NinjaTrader 8. And what I'll be sharing with you today is what I used in my institutional trading career and now use in my own trading. The barriers to entry in the financial industry have changed over the last 15 years, right? When I started, there was exchange floors. You could literally walk down to the floor, befriend somebody, and by the end of the day, hopefully have a lead on a job. Now trading firms are only hiring mathematicians and scientists. They're only taking people from top schools with certain degrees. And the opportunity isn't there for new traders to learn from existing traders because you're not going to get in those jobs. Whereas before, you go to the trading floor and you can talk with successful traders, people trading in the pit, and eventually it will lead to other relationships where you get to meet the people on the other side of the phones, some of the greatest traders in the world. So before I begin, I want to take this time to invite all of you to follow me on YouTube. Just go to go to YouTube, search order flows, subscribe to the channel. I've got about 250 videos on there. It's very informative. People always ask me, what's a great place to start with order flow? I say, watch my videos. It's free, and that's a great place to start. But before I jump into everything, a brief disclaimer. I want you to understand trading is risky, especially in today's environment, right? The volatility, the VIX is at such high levels that trading right now for a lot of people, they are getting hammered. There are people also making a lot of money, a lot of quick money, which I think sometimes is a bit of a bad thing because sometimes people in market environments where it's so choppy, people think trading is easy because they just put a bid and an offer in it, and within a second they're filled on both and they just made $100. They think, oh, this is easy. But the reality is, markets will calm down. This extreme volatility, these wild price fluctuations are not normal. It will take a while for the markets to return to their normalcy. So over the last 5 years, since I've been dealing with retail traders, in the past, working in institutional side, I was surrounded by very good traders, traders that literally have written books, traders that have been worked at all the major trading firms. And I've been exposed to a lot of different trading methods. But now over the last 5 years working with, retail traders, I understand what a lot of the problems are that they're facing is because they just deal with one piece of information and they're trying to take that one piece of information and make all their trading decisions based around it, right? They're trying to find exactness in the market with just one piece of information, and that one piece of information is price, right? But they're missing a big important component. The big important component is volume, right? Because volume is the piece of information that tells you the commitment of other traders to the market, right? It's going to help you identify the behavior of the other traders you're competing against, right? I don't want to say trading against, even though you are trading against them, but in reality, you're competing against them. Okay, and you have to, if you've ever run a race, sometimes you're getting close to the finish, you're trying to elbow the guy next to you, try to get that little bit of an edge, you're looking there, can I lean my head forward? You want to get that little bit of an edge to finish first. And people say, but Mike, volume, yeah, I don't, volume's not that important, price is important. Well, if you've ever run a business, right now, so many people run online businesses, from home, right? They sell on eBay, they sell on Amazon, they got a Shopify store. Well, they don't just keep track of the price of the item they sell at, they keep track of, there's so many analytics, right? They see that, well, if I start selling this book at this price, I sell a lot more. Like in the old days of eBay, you'd have an item, you could start it at 99 cents, you'd get a lot of interest in it as price would go up. But then if you take that same item and you put it out there, say, oh, well, I'm going to sell it for $100, even though it's worth $200, you're going to get nothing, right? You get one bid late in the auction and you sell it for $100 when you could have sold it for $200 starting at 99 cents. So, you're going to take into account all these other factors like, what am I selling at this price? What am I selling at that price? What am I selling at this price? And, if you've ever run a business, you're going to have a break-even price that, if you're above or below it, it doesn't matter. If you're below it, you could sell 1,000,000 copies of a book, but if you're 1 cent below that break-even price, it's pointless, right? So once you understand the importance of volume, you can begin to analyze it and find hidden trading opportunities that traders are overlooking. Why are they overlooking at it? It's no secret. They're not looking at volume, right? Remember, markets trade in a two-way auction. There's a bid at one price and an offer at a higher price. And in the two-way auction, right, for a trade to occur, a trader must buy the offer or sell the bid. Otherwise, the market will just stand still. No trading will occur, right? In the past, a lot of exchanges, especially the ones in Asia, they used to have basically a fixing, right? Say when I say in the past, in the U.S., is how they used to do it, a century ago, is that they basically say, okay, everyone will come in, work their bids and offers, and then boom, when everybody is satisfied, that's the one price everything will trade at. We don't do that anymore. We trade in a two-way auction, and we've been doing this for a long time now in the U.S. And basically what you have is you have a bid and an offer. You can see this is a dome, right? This is the Ninja Trader dome on, what is this, the E-minis. For a trade to occur, someone has to buy at the market or sell at the market. And you're going to basically, in this case, the market is 24.56 bid, offered at 24.56 and a quarter. Everybody that's working to buy it at 56 and below is what's considered a passive trader. Everyone that's working to sell it at 56 and a quarter and above is also a passive trader. But for a trade to occur, somebody at 56 and below has to get aggressive and buy it at 56 and a quarter. That's what you call an aggressive trader. Aggressive trader is going to buy from a passive trader, just as if the market was to go down, someone on the passive side on the offers, someone that's working at 56 and a quarter, 56, or even someone just coming into the market, oh, I think the market's going down, I just want to sell it at the market. They sell the 56s, they sell the 55 and three quarters. That trader is being aggressive. They are hitting the bid. They're selling at the market price. And once you understand how trading works, then you can start to understand order flow, right? And there's three key data points in order flow that you need to know: delta, imbalance, point of control. Now this chart here, this is an order flow footprint chart, okay? And it takes all that information that you just saw on the dome when a trade occurs, and it puts it into a nice, easy to read format. And from that format, it generates other pieces of information, okay, which I will go through. First is the delta. Okay, the delta on most software, mine especially, it runs it on the bottom. Okay, delta, max delta, min delta, cumulative delta. Okay, it's the net difference in a bar between aggressive buyers and aggressive sellers. If a bar has positive deltas, you would say buyers are in control of that bar. If the bar has negative deltas, sellers are in control of that bar. Now there's a max delta, which is the strongest delta was in a bar at one point. You have a min delta, which is the most negative delta was in a point. Now, max delta could be 0, min delta could be 0. Generally, on one-way bars, bars that just shoot straight up or bars that shoot straight down, you may get bars shooting straight up. You'll have all max delta, 0 min delta. Just as a bar that goes straight down, basically, even though there is counter trade in the bar, at no point where buyers in control. If the bar was straight down, everyone is hitting the bid. There might be some counter trade, but at no point where max delta positive. So at no point in that bar where buyers in control. Now the next point is imbalances. Okay. Now imbalances occur in the two-way auction between the volume traded on the bid versus volume traded on the offer. And generally, if it's greater than 4-to-1, you consider it an imbalance. So remember, right, the market trades bid against the offer. Okay, so for example, here on this chart, at 174.53, it traded 0. At 174.54, it traded 115 contracts right here, right, the two-way auction. Okay, so 0 against 115, obviously it's greater than 4-to-1. That's why the number is blue. You have a buying imbalance. Now, up here at the top of the bar, you got 257 traded at 58 versus 3 traded at 59. The 257 against 3 obviously is greater than 4-to-1. This is a selling imbalance. That's why the number is red in the bar. Okay, and there's ways you can interpret the imbalances in a bar. I've got a lot of great videos on my YouTube channel about that. And lastly is point of control. And it's simply the price level in a bar where the most volume traded. And it could often act as support or resistance, or some people like to say supply and demand, over the next bar or bars. And you can see here, every bar has a point of control. Whether it's a red candle or a green candle, it has a point of control. Now, the beauty of point of controls is there are some cases where the point of control is very important. It represents, stopping volume. It represents a big offer coming into the market or a big buyer coming into the market, and it could act as a floor or a ceiling in the short term at least. Sometimes it acts as support or resistance over the longer term. Again, it depends on the type of chart you're trading, whether you're trading a 1 minute chart or you're trading, a 15-minute chart. If you're trading a 1 minute chart, I wouldn't look at, a certain point of control as being support for the entire day. If I was looking at a 15-minute chart and I saw an important point of control, one that mattered, it might very well be the support for the entire day. Now, it's through the delta, the imbalances, and point of control that a trader can see inside the bar and understand the market internals. Most traders think they're looking at a candlestick chart. They think that they're reading the order flow because a red candle represents a bar that opened high and closed lower. A green candle represents the opposite, a bar that opened low and closed higher. Well, I'm reading the order flow because obviously buyers are in control of that bar. Well, in a basic sense, yeah, you got to also remember, depending on the type of chart you're looking at, it's time constricted. So if you're looking at a minute-based chart, it can just close. Even though if you were to give it an extra 2 seconds, it might, instead of being a green candle, it could be a red candle. You're not really understanding what's going on in the market, what's going on in the order flow. So let's take what we've just learned about order flow and start applying it to the market. So I'm going to get into the 5 practical uses of order flow in trading that you could go take away from. And if you have a footprint chart, you can start looking for these situations. So the first one is recognizing market transitions in supply and demand with order flow. And like I said earlier, right, delta is the net difference between the aggressive buyers and aggressive sellers in a bar. Every bar has aggressive buyers and aggressive sellers present, but when one group is clearly in charge, it's going to help determine the direction of the market. And that's important because, generally speaking, a market will rise on positive delta because buyers are buying the existing supply and willing to pay higher prices for more supply, right? We've seen it with this panic buying, ahead of government shutdowns everywhere. There's a lot of demand for everything. People are buying all the existing supply, even if the stores raise their prices, a little bit, they still buy more. Now, when a market sells off, you see negative delta in bars because sellers are aggressively distributing their supply. They're hitting the bids and they're looking for buyers and selling to them. If all of a sudden Charmin comes out with, 10 warehouses full of toilet paper and starts putting them into the market, people will still buy them. But at some point, people will realize, hey, I got 100 rolls of toilet paper right now. I don't need any more. To move those toilet paper, Charmin's going to have to keep lowering the price. As people, well, I don't want to buy it at $5 a roll, but I'll buy it at $1 a roll, right? So it's going to take some time for Charmin to get the price down, right, with their supply. So like I said, as markets go up, delta is generally positive, right? You can see here as the market is going up, mostly you're having positive deltas. You do get, the occasional down bar here, a small bar with negative delta, right? But as the markets go up, you see nice positive deltas. As the markets start coming off a little bit, you got negative deltas, right? This little patch in here, negative deltas, market starts going up, you got positive deltas, market starts coming down, you got negative deltas, right? So that's how delta is going to help you a bit. But where a lot of traders get lost in order flow is putting the pieces together, right? Order flow in isolation does give you clues as to what's going to happen next. But when you put the pieces of order flow together, you start to see things happening in the market as it happens right now rather than later, right? And when you start putting them together in context, you start seeing patterns occur. Now, what I see here, okay, this is a market that's transitioned from a demand-driven market to supply-driven market. What do I mean by that is how can I tell? Well, I see all of a sudden sellers taking control of the market. We're at our high, market's going up, we got a nice strong positive delta, but we hit our high, sellers are coming in. right? We got negative delta, minus 40, next bar, minus 86, next bar, minus 382, right? So you got to be asking yourself, anytime you hit a high or a low, is this market going higher or lower? Okay, and we hit our high, and sellers are attracted to these high prices. They start coming in. Hey, this is a great sell up here at 44. I want to get some, right? They start selling it. Other traders realize that, yeah, hey man, this is a good sell. They start selling, 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 right? Trading sometimes is a herd mentality, right? Once, back when there was a pit, sometimes you would see, people, guys on the floor would know which trader behind the phone was calling in, right? So they would know that if it was a Commerce Bank, at 3 o'clock, if it was Commerce Bank coming in to start trading the S&Ps, they would know that um, it was pro funds behind it, the big hedge fund, you know, positioning themselves for the market. So other traders would see that and they would come in and start doing the same thing, right? With traders, there is a herd mentality. So, once you start seeing the selling coming in here, everyone else starts seeing it, it starts coming off. And you see by the time you get to this second blue bar here, this is the area you'd be getting short. That's a quick 20-point drop right there in the S&Ps on a 1-minute chart. Okay, now what do you have here, right? Again, S&Ps, this time's a 5-minute chart. People say, why you show a 1-minute chart? Why you show a 5-minute chart? Am I supposed to keep flipping back and forth? No, I want you to see that it works whether you're using a 1-minute chart, whether you're using a 5-minute chart, whether you're using a 5,000 volume chart, or, a range-based chart. Concepts of order flow apply to those types of charts as well. But in this today, I'm just going to show mostly just 1-minute chart and I think 5-minute charts, all in the E-minis, maybe a crude chart thrown in here or there. So we're coming into the low. We hit our low. All of a sudden you see positive delta getting stronger, right? We hit the low. We got a strong negative delta, minus 1349. That's like the last push of sellers coming in. All of a sudden people realize, hey, this is cheap. They start buying it, getting stronger. Next bar, buying more. Next bar, buying more. And then the next bar, you're talking a move from 26 all the way up into the 50s. Because what's happened is the market has transitioned from, supply coming into the market, helping move the market lower, to all of a sudden demand coming into the market at these lower prices. This is what I have an indicator on my website. It's called the delta surge. But again, if you just look at the delta, you can see this, right? You can see how, first, you're sort of going sideways, then the negative delta starts expanding, right? Minus 59, minus 604, minus 662. Market drops a little bit, about 10, 15 points. Then sort of comes back up again, starts going sideways around that same level. And then more selling comes in, a second wave of selling. All right, this time, you hit the high. As you hit your high, you got your strongest negative delta bar, right? It was creeping up a little bit, minus positive 274, minus 130, minus 520. And then boom, the sellers just slammed everyone that was buying it. You got imbalances in the bar. And then boom, it goes from 70 down to 50 over the next 3 or 4 bars. But again, you don't need an indicator. You could just look at the delta and see that information. Actually, I used to trade a commodity in Malaysia, and it's called palm oil. Unless you're, sort of an addict to the markets, you're not going to know what it is. But in Malaysia, in the U.S. you have soybean oil, you have cooking oil, canola oil. In Canada is a big contract, but Malaysia, it's palm oil. That's their biggest contract over there. It even trades more volume than their stock indice. And but it's a very small market, and oftentimes you'd have people accumulating positions without trying to move the market. That's where I first noticed this pattern in the order flow, right? We would be moving basically, back and forth, back and forth. Then I would just notice sort of this pickup when traders are starting to get aggressive, and you'd see it oftentimes like this, where it got slammed right here. You'd see it, boom, finally, people that are distributing their position, people are hitting all these bids, causing that negative delta, have finally overrun the people bidding the market. The people trying to support the market, the passive buyers sitting there working bids, thinking this market's going higher. But I can tell that the sellers are getting more and more aggressive, right? That they're not yet moving the market, but I've found that usually after the third strong delta in a direction, either positive or negative, that's when the move happens. Again, this is E-minis. This is back to a 1-minute chart. You're coming into a swing low, and you can see how the market just, boom, it just is beautiful, right? It just comes down in here. It's weak. It's weak. All of a sudden, boom, you're at your low, but instead of still showing weakness, it's showing strength. Aggressive buying coming in over the next 3 bars, and then boom, the market pops up. It's not something that you're going to see 100 times a day. Depending on the market, you may see it, 3 or 4 times a day. But when it's there, take it in context with what's happening in the market, right? If you're looking to buy, you want to be buying after the market sold off, right? After the market hits a low, you want to be looking for aggressive buyers coming in. Sometimes people will say, well, we just rallied all the way up here, 20 points, and then, there was 3 bars with strong positive delta getting bigger, but the trade didn't work. So, order flow is hogwash, but they're not using it in context of the market, right? They said if the market just rallied 20 points rather than looking for a point to buy again, potentially you should be looking for a place to get short if there's something in the order flow. So again, take everything in context of the market. And, delta is, again, the net difference between aggressive buyers and aggressive sellers in a bar. Once you start analyzing delta in relation to surrounding delta, you see clear market patterns. It's like taking a walk on the beach and you find a perfect shell, right, among all the rocks. The perfect pattern in Mother Nature, the Nautilus shell. It occurs, right? It may not occur as often as we like, but it occurs often enough that you can take advantage of it. So the next setup, I don't know, I hate to call them setups, but the next condition I want to explain is distribution and accumulation at tops and bottoms for low risk trades. Low risk trades is something we all strive for. We all want to have low risk trades, right? Because no one wants to risk excess amount of money. At the end of the day, we're all cheapskates. I hate to say it, but you don't want to overpay for something, right? And if you overpay for something, you want to know that your downside risk is limited. Okay, you spend a lot of money buying a Ferrari, your downside risk is limited because there's a big resale market. If you overspend on a purse or something like that, a jacket, you know, you probably overspent, and it's not something that you could easily resell and recoup your money back. So spending $5,000 on a Burberry raincoat, as my wife really wants one, it's not always a prudent decision. You can get a perfectly good raincoat for $100, right? So it's unless you're Montgomery Burns or something, you got to think of the risk rewards. Why would you overpay for something? You're taking a big risk on it. And areas of accumulation or distribution are generally low risk entry areas, because once you realize and once you recognize what's going on in the market in the order flow, you can set tighter stops. You have areas you can hide behind. What makes accumulation and distribution trade setups so attractive is they often occur around daily highs and lows, as well as swing highs and lows. So you are trading around market structure. Everyone says, well, I looked at market structure, et cetera, and I took my trade. Well, most people don't understand market structure, because I see them go out, then they do the opposite of really what they should be doing. So let's take a look at this chart. So as the market trades sideways to a little bit higher, what do you see? Okay, you see mostly negative delta. Okay, market is just going nowhere. You got negative deltas. Okay, so what's going on? Well, aggressive sellers are hitting the bids. There's a lot of people working bids, but the aggressive sellers keep hitting those bids. So two things are going to happen. One, either the aggressive sellers are going to run out of supply. If that's the case, expect the market to keep going higher. Or two, the demand, the people that are buying, working bids, if the market is, trading 46, people say, well, I'd be happy to buy it at 44. They work bids at 44, 42. It trades down there, market goes back up. These people that are buying it at 44 and 42 are thinking, yeah, I'm a market wizard. So they keep working bids, working bids, working bids, but those bids keep getting hit. They think it's free money coming to them, because the market keeps popping up. But what's happening is these sellers, these aggressive sellers, keep hitting those bids, and then they back off. They let the market go back up, gives people a false sense of security. Market goes back up, they hit those bids again. But sooner or later, one side is going to win, right? So you got to be attentive to what's happening in the order flow. Watch the deltas is the key, because once the market starts selling off, price action traders would get short, underneath this swing low, but order flow traders are going to be getting short up here in this congestion area because they're looking for that break before it breaks through a trend line, all right, or before it breaks through a swing low, right? They're able to recognize up here when we're trading in the 40s rather than down here when we're trading in the 30s. So you're seeing, the market is just basically going sideways, mostly negative deltas, and then boom, you get a big bar, big strong negative delta. Previous bar, people say, well, you had a big strong positive delta. Okay, big strong positive delta, but the next bar couldn't build on it, right? Instead, it became all negative. It's all strong negative delta. It's your strongest negative delta in the whole sequence. And then you go inside with a small delta of 90, and then another strong bar of minus 500 delta, right? And finally, where's the bidders? They're gone. Boom, the selling comes in, minus 1,000 delta, minus 1,500 delta, minus 800 delta, minus 700 delta, as you drop from, 38 all the way down to 18 over a period of 4 minutes, right? That's how putting together the delta over a period and putting it in context of the market is going to help you find low risk trades. If you're getting short here, where's your stop? It's just right up here. You have your swing high up here at, was that like 49, but you have this lower higher high here at 48 with the big positive delta, which everyone's, oh, this is it, we're going back up. But the next bar couldn't even reach that level, right? So you're staying below 46. So if you're getting short, at 44, you have a stop up here at 48, to catch a big 20-point move down. So I'm going to show you a sequence of charts. This is part one, right? As the market reaches new highs, it keeps registering positive deltas in just about each bar, right? But once it reaches the high, negative delta bars appear. So, we're marching up, right? Got nice positive deltas each bar, okay? Hit our high. What do we see now? Negative deltas. Do you think this market's going to go higher or lower at this point? Well, we got one bar positive delta, 700. Okay, but then sellers came back in, minus 400, minus 200, minus 385. It didn't build on that positive delta. Market's not going to go higher on more negative delta, even though, it did get a pop here in this bar, did trade a little bit higher, but then the selling came in, market starts coming off, right? Where is your positive delta that you saw on the run up? Instead, you're seeing the opposite. You're seeing negative delta, right? This is the second half of the same chart. What do you see as you see hit your high? Again, it's just all negative deltas as the market sells off. When you do get positive deltas, they're relatively small, 249, other than the 701, but 249, 96, 50, 101, 3, 341, but it's just being overrun by sellers. Minus 400, minus 200, minus 385, minus 83, minus 390, minus 87, minus 221, minus 443, minus 581, as the market keeps tumbling. So once those aggressive buyers are gone, now the aggressive sellers are in control, right? And you can see as the market sold off. Here's another example. This one's a little bit more choppy. You make your highs, you're going up on, decent positive deltas, 800, 900, 1200, 1900, but you're struggling here to go higher. Why? Is because aggressive sellers are coming in. Minus 500, minus 1,000, minus 286, 299. I mean, you get a bar here with some decent positive delta, 400, but you can't even reach the high. And then it comes right back with a big strong negative delta. Again, you put in a little half-hearted rally back up here to the high, but where's your strong delta that you saw earlier? Earlier you saw 800, 900, 1200, 1900. Here you see 200, 300, 10. 10 is nothing. 10 is practically neutral. Might as well be minus 10. Then you got 268. Then you're just hanging around the high, minus 15, minus 17, boom, minus 576, right? So this takes us to where's minus 576. Again, you make that run back up to the high again. This is just the same chart, just a little bit later. You make a third attempt at the high. You can't even hit the high, but as you know, you're two ticks off the high, and again, it's just all negative delta, minus 55, minus 122, minus 647, minus 293, minus 376. At this point, what do you think is going to happen? Where's your aggressive buyers to take the market higher? They're not there. So again, if you're getting short somewhere in here, around the 84 area, you could have a stop up here, just above the high 88 or something if you want. But it's really, in these markets, you got to have something, a end of the world stop someplace. Trading without stops in these markets is quite deadly. But I used to have what I call a worst case scenario stop, which would be, right above the high, maybe a point or two above the high, just, in the worst case scenario. So maybe I got a 5-point stop here, but it goes from, the 84 area down into the 60s. So maybe I'm risking 5 points, worst case scenario. But honestly, if we start coming back up here and I see positive deltas, yeah, I'd get out at half the loss rather than take a full loss. But instead, you're risking, 3 to 5 points to get 15 to 20 points. So here's another example. This is the market at the low of the day, right? As a trader, you should be asking yourself, anytime the market's at a higher or the low, what's the market going to do next? For at the low of the day, are we going to go lower or are we going to go higher? Are we going to get a rally? So we're at our lows, we're just hanging around the lows. Okay. Do I see more aggressive buying or more aggressive selling? Well, I see mostly positive deltas coming in here, right? I'm picking up clues in the order flow that buyers are aggressive at these levels. They're trying to buy as much as they can without moving the price. That's what institutional traders do, right? That's what these algos, fancy algos do, the sophisticated ones for the banks. They want to trade as much of a position as possible without impacting the price. And if we're at the low of the day and there's an algo kicking off telling to buy this boatload, they don't want to move the price higher, right? They want to get as much as they can in at these low prices, right? So they buy some, right? But it's showing up here in the delta, right? It's mostly positive deltas. Aggressive sellers aren't in control of this low. Aggressive buyers are. And finally, the rest of the world picks up on it and the market pops from 50 all the way up, over the next couple of bars, close to 70. But again, if you're buying down here, you're buying it somewhere around 45, 46. Where's your stop? The low of the day is 2.5. Say you have a stop here at 40 and you're buying it at 45, it's a 5-tick stop for what? A move from 45 all the way up to, 60s, 65. So, the most powerful computer, I tell people, is the one between your ears. It's your brain, right? Recognizing accumulation and distribution can be obvious at times just by asking, what is the market doing right now? For example, you're at a low. Is there still aggressive selling or is there aggressive buying present? Like just like in the previous example, I like to play this game with my kids. What do we know? Right? Especially if they lose something, what do we know? Where were you last playing with it? Sort of go back, and look at the facts. If we're at the low of the day, but I don't see aggressive selling, or if I see aggressive selling and it's not as strong as it was earlier coming into that low, but I start to see signs of aggressive buying, that's telling me the market is getting primed for a rally. All right, so the third sort of trade setup I want to talk about is stopping volume and how to use it to your advantage, right? Stopping volume is like a car hitting a brick wall, okay? And the thing that really drives me nuts a lot about traders is when they start looking at support or resistance, they think of it as a particular level, one level. If price gets through it, that's it. Support is broken or resistance is broken. They look at it as one specific price level. And again, that's what I was talking about earlier, where traders that rely solely on price sort of get blinded by everything else. Like, oh, if we violate this price by 1 tick, then it's invalidated. No, it's not. That just basically shows not a firm understanding of how the markets trade. Even if, there's an iceberg order, there's going to be times where, the order has to reload and you could tick through it. So even that's not exact. But there are several ways to see stopping volume in the market. And, for those of you that aren't familiar with what stopping volume is, it's basically a big offer coming into the market to stop the move up, or a big bid coming into the market to stop the move down. And the easiest way to look for them is in the point of controls. And every bar has a point of control, but when there is a bar with a point of control that matters, or one that will act as support or resistance, that's what I refer to as a prominent point of control. Now, the order flows trader software is going to highlight to you when one appears, right? Before I was showing you delta, right? You don't need the order flows trader software, but if you have the order flows trader software, I want to show you some of the features here that you can use to identify market generated information, such as a prominent point of control, which is stopping volume, right? Again, you got to let the computer sometimes do the work for you. Now, in the software, there's a setting called POC Trader, and it allows you to set up to 3 levels of prominent points of control. And I used to have this as a separate indicator, a separate tool rather, but I incorporated it into the main order flows traders because it became such a regular part of my analysis. Like in the past, I would sort of just eyeball it and say, yeah, I think that one's a stopping volume. But with the computer, it can do the work for me and will highlight the areas where there's stopping volume in the market. And as you can see, it will color it magenta for resistance, or cyan, which is like a light blue for support. And there's actually 3 here, right? There's one over here, which I didn't highlight, but you can see how the next bar traded right up to that level, came off. It did come back up, get through that area, but this area, even if you were to draw that line, is acting as a resistance area. But over here, you have a lower resistance area, and you can see how the market keeps coming back up there, keeps coming back up there, keeps coming back up there, before it finally pukes out and falls over. All right, people, there's somebody in here with offers holding down the market. All right, they're offering resistance. That's what stopping volume is. Stopping volume is going to stop a move. Right here, sharp move up, boom, sharp move down. But there's supportive volume in the market coming in here. Right, you can see this point of control aligns with these point of controls earlier to the left. Right, you got 3 point of controls at the same level. The market does trade 2 ticks through. Again, it's not the end of the world. Oh my gosh, we traded 2 ticks through. This prominent point of control stuff is rubbish. No, especially in these volatile markets, sometimes you got to realize, right? You just came from 35 down to 25, bounce up a little bit. There's still a little bit of selling pressure left to get through, and then boom, once that selling pressure is exhausted, support comes back in the market rallies back up. Okay. Again, the stopping volume is going to cap moves up, but more importantly, it's going to help you find reversals early. Again, here's a nice capping volume, right? Stopping volume up here, the high of this red bar. And again, you're alerted to this as soon as it's forming, right? This is a 1-minute chart. If you're trading a 1-minute chart, you know that at 55 seconds, chances are that bar is going to finish the way it looks after 55 seconds on a minute chart. And if you're getting short, you can be getting short up here around the 50 area, 49, 50 area. People that are drawing trend lines are drawing them from the swing low here, drawing up like that. They're getting short in here when we break the trend line at, whatever, 45 or 44. You're getting in a full 5 points earlier than everybody else using traditional technical analysis, right? Now, for volatile times like now, if you want to expand the prominent point of control, you could actually expand it to a level of 5. I don't want to get into all these settings right now, but I just want to show you if you're looking at a longer term chart. Right, people say, well, I look at a 15-minute chart, can order flow help me? This is a 5-minute chart, sort of what I call expanding the net. Here you got a nice prominent point of control sticking out up here, right? It's like a sore thumb showing up in here around the 2600 area. Over the next couple of bars, you got plenty of time to be getting short around the 92 to 95 area before it sells off below 70. Again, that's a 5-minute chart. People always ask, well, I trade a 5-minute chart, I trade a 15-minute chart. Can I use order flow? Yeah, you can, but you may have to adjust some of the settings a little bit. Like if you're using a prominent point of control, you want to expand it a bit. Here's another beautiful example on a 5-minute chart. Again, you don't have to wait till the 5 minutes end. People say, well, normally me, I like to wait for the bar to end, but honestly, if I'm trading a time-based chart, I know that when the timer gets down to a few seconds, it's pretty safe to take the trade. And look at that, it's a move from the 70s again down into the 50s. So points of control are very revealing to a trader in relation to value and volume. When POCs occur around swing highs or lows, it can very often signal a reversal in the market because there's important volume there to stop and reverse a move. The order flows trader analyzes the order flow to highlight these prominent points of control for you. Now, the fourth one is I'll show you how to easily see price rejection to keep you in winning trades longer. And as I was preparing this, I realized I also want to show you another way to use price rejection. But let's talk about price rejection at first. What do you think happens when traders reject a price level? Put it in context, okay? Always put trading in context. The bar opens and starts trading. What's going on? The market is looking for price acceptance, right? At a price level where there's acceptance, traders are happy to transact. At a level of price rejection, few traders transact. So think about that. Where you have price acceptance, traders are happy to transact. That's going to be your point of control, your POC, your area with the most volume, because generally that's going to be your value area for that bar. But at levels that they reject, there's going to be very little trade. People don't want to be buying the high. People don't want to be selling the low. So how does a trader see it in the order flow? Well, you look at the edges of the bar for abnormally small volume. Now again, what is abnormally small volume? It depends on the market and time frame you're looking at. It's safe to say volumes of 10 or less is small, or even in less liquid markets, like say the NASDAQ, volumes of 5 or less is going to be small. Again, it's going to depend on your market. And one of the obvious benefits is being able to keep track of the volume being traded on the bid and the volume traded on the offer, right? That's the benefit of order flow, is keeping track of that information. Again, if you're looking at time and sales or a dome, oh God, your head's going to spin if you're looking at this. It's just going berserko, right? You're not going to keep track of a time and sales, and keeping track in your head on a dome is just as hard. What most traders think, when they start trading with the dome is they think they're Rain Man. They think they're going to all of a sudden figure it out. Well, honestly, I've been looking at dome since dome trading started back when the electronic trading started and the exchanges had the depth of market. And for a lot of traders, they don't really understand what they're looking at. But really what the market is telling them is, do you understand the words coming out of my mouth? Do you understand what you're seeing in the order flow? And let's be realistic, right? You got to think of the current market situations, okay? All right. And trying to figure out what's happening in the dome is going to give you a headache, right? The market's going to be moving super fast that, trying to figure it out is just going to be, too much for anybody. Honestly, it's, keeping track of what you're looking at in the dome is going to be blinding. It's just going to be happening so fast that you can't. Okay, I thought that was video was supposed to be working there, but it's not. Oh, there it is. But this is the dome. This is, you look at this. This is Nasdaq. This is a few weeks ago when we're trading in the 9,000s. Try keeping track of that information that's going through on your on your dome. It's practically impossible for most people, right? And you say, well, I'm going to look at a dome and become a successful dome trader. Well, in the 3 seconds, it's sold off from 49 down to 45, and you're not going to remember what happened at 47. You're not going to remember what happened at 48. So, for a lot of people, trying to figure out what's happening in the dome is a waste of time, right? Being able to keep track of reference points, price levels where interesting trading occurred is going to give you an edge over other traders, right? Because why, again, the benefit of order flow, right, is going to give you references. It's going to put it on the chart. It's going to put basically everything that's traded on the dome on the time and sales is going to paint it for you on the chart. It's going to fill in that information, volume traded at price, so you can maintain perspective of what's happening when the market heats up, right? When the market is moving fast, you don't have to sit there and try to rely on your memory, right? You want to be able to remember, you want to be able to identify the behavior of other traders that you're trading against. And if prices are being rejected, you want to know which price. Now, when I released the initial version of Order Flows Trader many years ago, this was a main component of it, right? It's what I call small digit prints. It highlights price rejection. Now, it can be used in two ways: to keep you in winning trades longer and show you potential trades, okay, potential reversals. First, I'm going to show you how price rejection, single digit prints, will let you stay in winning trades longer. If you are long, you want the market to go up, right? Obviously, a sign of market going up is higher highs, but also a sign of market going up is lower prices getting rejected. So a clear sign that lower prices are being rejected is in subsequent bars in a move. You see very little volume being traded on the move up. And what the Order Flows Trader software will do, which I showed you that little setting, you could set the volume to highlight where, it'll put a little box around a green up candle if it's price at the bottom of the bar is being rejected. Well, everyone's going to say, well, Mike, every bar's got a low, so the low is being rejected. Yeah, but there's certain times where the volume that's being traded there is very little in relation to normal order flow, okay? Bars trade normal order flow fairly regularly. It's when you don't have the normal order flow that you want to be alerted. Honestly, before I even put this in the software, I used to just trade this. I would just sit back and look for these bars that had very small volume at the bottom, and I would just trade the next bar, here, right? If I trade this first one, buy it at the open, get out at the close. Next bar, I could do the next bar also, but if I come here, I buy it at the open, it starts going up, and it comes down. Okay, I take a small loss. Next one, I buy at the open, I get long, go up. This is a sell up here, but I'm just showing you as the market moves up, here you have price rejection on the top of this red bar. I get short, boom, get out on the close. There's so many different ways you could use it, but in the crudest sense, that's how I used it in the past. Again, here's more signs of price rejection as the market is moving higher, right? So if you're in a position, say you're long or short, what you want to be looking for is, signs of footprints, so to speak. So it's called the footprint chart, trail being left behind that those prices are being rejected, a clear sign that higher prices are being rejected in subsequent bars. In a move down, as you see, very little trading at the tops of red candles. For example, right? If I'm short somewhere in here, right, and this market starts selling off and I'm seeing red candle, or sorry, I'm seeing price rejection, price rejection, price rejection, it's going to tell me, hey, I could stay in that trade a little longer, even if I see, a potential prominent point of control like this one down here, but then I say, well, the market, yeah, maybe I want to get out, but I'm still seeing price rejection, right? It's going to keep me in that trade a little bit longer. So as the markets move lower, there's price rejection, right? We got a nice stack selling imbalance in here. We got 3 imbalances, right? We trade up through it, price rejection, okay? I'm getting short. Next, another bar, price rejection, okay? I come in here, well, I got a bullish prominent point of control. Market rallies up, rallies back up into my resistance. That's what I talk about, being able to put the pieces together, but then it closes down, okay? So I'm a little wary of this bullish prominent point of control because I'm looking at a lot of bearish things in here, right? Next bar, 2 bars later, a price sign of price rejection. So instead of saying, well, I'll just cover it down here, well, no, wait, I got a sign of price rejection here, which follows the price rejection from the previous bars. And then boom, the market drops from 70 down to 50s. Okay, so I'm able to stay in that trade longer, then it hits a price rejection, a bullish price rejection at the low of the day. What happens? Market trades right back up to that area where we were earlier. So the other way that sort of leads into this next part is using single digit prints to find reversals in the market, right? And if you're looking at a candlestick chart, you're not going to see this information. You're not going to see the volume traded at the bottoms here, right? But if you're looking at a footprint chart, you would see, I only traded one. What's happening? You come down here, you trade 12 on the bottom. Come down here, boom, it hits it a little bit more, 24, 33 again. Market rallies back up, selling comes back in. Doesn't hit the bottom, next bar, one lot trades. Where are those sellers? Earlier you had 33, earlier you had 24. You only got one this time, market snaps back. Imagine you're buying this next bar, at 40, what is that, 47, just the one bar, right? 47 all the way up into the 60s before it closes. But again, if you're looking at a bar chart, you're not going to notice that. You're going to say, well, the bar was green or something. We tested it once, two, three, four times, then it didn't work. I would have bought that bar. Most people wouldn't have bought this bar. But if you're watching the order flow, you would have. Most people say, yeah, I would have caught that. But reality is, no, they wouldn't have, right? They wouldn't have. Okay, here's a nice swing low coming down into the swing low, a nice V shape, right? Boom, sharp move down, sharp move back up. What's the sign? 4. Now again, there's the signs in the delta as well, that this market is also getting ready. You also got imbalances as well. But the first clue, most obvious clue, is that small digit print right there at the bottom. Now, you can adjust the size right here. It's small print size limit 5. I prefer 9. That's what I've always looked for because it would give me a single digit. But, for very liquid markets, I said, up till about 3 weeks ago, on S&Ps on a minute-based chart, you could use 25. For 10 years, if you're using like a 5-minute chart, you could use 25. For thinner markets, like NASDAQ, I use 5. Okay, but again, it depends on the market, the duration that you're using. If you're using a 30-second chart, a 1-minute chart, you understand what is a small print for you, right? Most bars are going to have a volume at the lows or volume at the high that is normal. Here I have it set to 10 or 9 rather, so you got the 7 here at the swing low. Here's a 4. In most bars, you're looking at volumes. 29 is average, 14 is average, 23, 46. Nothing special. 26, 41. It's when you get those small digits. 2. This one's a 9. Here's a 4. Here's a 7. Just as on the red candles, 6, 5, 4, 6. Here's that another example at the high, right? Then you start putting it together with other things, right? You got a bearish prominent point of control. You got your small print up here, and it's a nice move down. I mean, it's oftentimes traders like to have big fancy mathematical formulas and programs. All you gotta do is look at a chart, right? Small print, small digit prints on bar extremes are sign of price rejection. Or you could think of it as price exhaustion. Traders are tired of that price and don't want to trade it anymore. So the last one I'll talk about is using order flow to determine where a bar will often pull back to as soon as it opens, right? It's not magic. Traders are always sort of looking for this holy grail, this magic indicator, magic setup that is going to give them the answer to the market, but there is none, right? You're always, as a trader, I know for me, when I first started out, one of the things that I always wanted to understand is why does a bar pull back to a certain level and then continue on in its original direction? And again, if you're looking at a candlestick chart or a bar chart, most traders don't use bar charts anymore. They use candlestick charts, is because traders are more visual now, and candlestick takes into account the open and the relation to the close. Is an individual bar has a lot of fluctuations, right? This green candle could be a 1-minute chart, it could be a 5-minute chart, it could be a daily chart. But in this candle, there's a tug of war going on. It could go up, come off, go back up, sell off, rally up, come off again before rallying, right? You see this play out during the day. This could be, like I said, this chart here could be a daily chart, it could be a weekly chart, it could be a second chart even. For example, okay, chart on the left is a 1 second chart, and that all this price activity, up, down, is this one bar here, right? An individual bar is essentially a trading session, but in a micro sense. Okay, so if you're looking at a daily bar, right, back in the days, back in the 80s and 90s, people were, unless you're trading on the floor, most people really weren't into intraday price fluctuations. Most every trading system that was out there was designed based on daily bars. And people would always be racking their brain, well, why did the market pull back, especially to this level, to a particular level from the previous day before rallying? Around that time, market profile came out and people started to understand that it dealt with the value, right? They would look at the market profile for the day. They would have a value area, and oftentimes the next day, the market would pull back to that value area, test it, and either break through it or continue on in its original direction. But with order flow, you can sort of take it on a more micro sense, right? So the question is, how can you use the information in order flow to find those areas where the current bar that you're in can trade back to and react from? Okay, so in other words, where can the current bar trade to and put in a low or a high, then reverse, right? You got to think about it for a second, right? Think about on a smaller scale. And most people are familiar with volume profile, right? They're familiar with value area highs, value area lows. Now, the point of control is a form of value in a bar. It's the price level where the most volume appears. And if you're familiar with volume profile, you understand that your point of control is the level with the most volume for that day, okay? Take it on a smaller level. The point of control is the level where in the bar where the most volume occurred. Now every bar has a point of control, okay? And as you can see here, right, on this move down, right, where does the bar trade back to? It trades back up around the previous bar's point of control. Here you got through it by a few ticks. Here you came up within a couple of ticks. Here you're well below. Here you're within by about 4 or 5 ticks. Here you got within 1 tick, right? So it's not a pure sense that it's going to trade right back to that level and go down. You know, it's an area, right? It's an area, and oftentimes it's going to keep you on the right side of the trade by understanding if you're short on this high, right? If you're short off the second bar, okay, I know the point of control is coming in here around 37. The next bar opens up, doesn't come up, doesn't test that level, starts trading below. Okay, the next bar stays below the previous bar's point of control, right? This is an area where if you're trailing a stop, you can hide behind, okay? Because it's going to give you a clue on where the bar can trade back to. Here's a market, right? Point of control is acting as support on the way up. On the way down, it's acting as resistance. You can see here it came within 1 tick. Here it got through it by 3 ticks. Here it came right to the tick. Here got within 2 ticks. On the way back down, these two bars traded 2 ticks above it. This one shot it a little bit up. Here you trade right to it. Here you trade 3 ticks through. Here you trade 1 tick past it. But it's going to help tell you an area where the market can trade back to. Okay, it'd be like I used to call it like Jack and the Beanstalk, right? Like magic beans. Knowing an area where the market can potentially retrace back to in the bar that you're in. Okay, on the way down, point of control is acting as resistance. Here it got within 2 ticks. Here it got within 3 ticks. Here it got within 3 ticks. You put in your bottom, starts rallying back up, comes back down to that level. Here we're still above it, comes back to 1 tick past that point of control. Here, the point of control is up here, but here we trade below it. This next bar, right to that point of control. This next bar gets within 3 ticks past this point of control. So now on the way up, it's acting as support. Now, seeing the price level where the most volume traded is all well and good, but you want to apply it to your trading. And as I showed you earlier, point of control can act as stopping volume for reversals. But now I want you to think outside the box and take it to another level. Okay, 1 point of control is good. But what if you can see some more, the next two levels, the next two point of controls, the next two high volume areas in a bar? Once you start seeing bunches of point of controls, including the second and third point of control levels, that's market generated information at your best. And in the order flows trader, we allow you to do that. You can see here, you can expand point of control 2, point of control 3. You could set them up so you can see the next two levels. And there are several ways you can use the 3 points of controls together. The first level is to find areas where each bar's point of control group is sort of bunched together with the bars around it. This is indicative of an extended value area forming. And if we start trading above or below that, you go in that direction as it's going to offer near-term support or resistance. And then more importantly, when the market starts trading back to that level, watch what happens. Is it support, or is it breaking through? I mean, is it going to be a resistance area, or is it going to be a support area, right? This is basic trading 101, right? Support becomes resistance, right? Here's your resistance, okay? You're forming, basically just migrating lower, a little bit lower each bunch. Normally you'll see point controls sort of spread out in each bar, but when you see them sort of grouped together like that, it's telling you there's resistance here, right? This area, there's strong sellers, okay? Now later when you come back up through it, you gotta be paying attention, right? We came back up to it a little bit later and we came off about 3 or 4 ticks, points. Then we came back up, it was struggling here, and then boom, it popped up. Aggressive buying came in and someone's just triggered whatever stops there were here, or someone swept through that market. That's, you see this big um, stack buying imbalance here as you go higher. Now this area that was your resistance is now your support area. Okay, so another example, right? You have these points of controls, these groups, 3 point of controls, stacked point of controls stacked on top of each other, but they're all coming in around the same area in here, right? See in this box here. Okay, we sell off, right? You see even the third, as we come outside the box, it comes in here and it sells off. Okay, starts selling off, comes back up in here, gets through it, right? Now what was your resistance becomes your support. Comes back in here, tests it, goes back up, right? Like I said, trading, just because you adapt order flow doesn't mean you have to abandon all your other styles of trading. You can still use basic support and resistance rules. Another way is to use 3 points of control is to look for groups of them migrating higher or lower. And what that is, it's an indication of value moving higher or lower. So like I said, generally points of controls aren't always bunched together, right? They'll be a little bit spread out, right? If you're looking at 3 of them, I see it'll appear point of control 1 will appear somewhere, then the second and third can appear anywhere. It really depends on the bar. But when you see sort of them bunched together, like this high, it's bunched together up here. Next bar, it's bunched together. Next bar, it's bunched together. These tight bars, value is moving lower, right? And boom, the market sells off. This one over here, you got 2, they're sort of bunched together, even though 1 is separated, and then a higher bunch. So that one's a bit borderline. Now, here you have bunch point of control, bunch point of control, bunch point of control, bunch point of control, all moving lower. What do you think is happening there? There's big seller here, big sellers here, big sellers here, big sellers here. And why? Not only are they offering it up, but they're hitting the bids, right? That's what's causing the heavy volume in those areas. And it's all happening in very congested areas. Here's another one. Points of control. This first one, again, it's 1 tick separates it. People ask, well, can you accept that or not? Well, I'd have to put it in context. I don't want to put down a rule saying, well, it could only be when they're stacked on top of each other. And if you have one that's not stacked on top of each other, like this one, it invalidates the whole thing. But when I see 3 stacked on each other, it's good enough. Even if I have one that's not stacked, I'd be willing to accept it. Sometimes people like to draw hard and fast rules, and it sort of goes back to, I think they're training. Programmers and engineers try to find exactness in everything, and sometimes you got to bend a little bit, right? But this one does have 3 stacked here in a row. I would take this one as the 4th one, and you see how the market moves higher. So point of control, represents value in a bar, right? Understanding where value is right now in the bar. Your trading is an extremely valuable piece of information, and don't overcomplicate trading, right? I've just showed you how applying common sense to the markets can help you in your trading, right? But you have to have the right tools, right? For me, that tool is order flow. Just simply looking at a chart. I've looked at a chart long enough that I can just pick up these things. But for most people, they need a way of learning it, right? And most people, well, now that we have a lockdown, the fortunate thing of the lockdown is you got a lot of time on your hands to study the markets. Don't make trading more complicated than it needs to be, right? Anyone could look at order flow just as anyone could look at a normal bar or candlestick chart. The key is knowing what to look for and what it means. So if you're interested in learning more about order flow, go to orderflows.com/OF2 .html. Okay, I've got a very special deal for everybody, and it's basically it's the software, but not just the software, right? Having software is one thing, right? You want to know how to use it. You want to get the most out of it, right? Just as if you buy a car, right? You want to get the most out of a car. You want to know how the seats go down so you create more space in the back. Everything. And for a limited time, right? I know we're on this. It's a bad time for a lot of people. For people that haven't saved, for those that have saved, are going to be able to weather the storm. Or, if you if you have a job and are confident you're going to keep it and you get out of this, much better. Now this is a time to improve yourself, right? Learn how to become a trader, not just follow signals blindly back and forth. Oh, this one is green, so I got to buy. This is red, so I got to sell. Learn how to become a trader. Learn how to read what's happening in the market. So for a special time, I'm going to give you the Order Flows Trader software, which normally is $8.99. I'm going to give you my Order Flows Trading course, which is normally $2.97, and access to my Inner Circle video series, which is a series of 56 videos, advanced training on order flow, right? Normally, if you were to get all this separately, it's going to cost you around $1,500, but I got a special deal for you. It's just $675 right now. So really, the only risk that you're going to have is losing this discounted one-time price, because normally I sell it at a higher price. Honestly, I sell this package at a higher price than $675. I sell it around $800. You're going to waste a year of your time, over a year of your time, trying to do this alone, try to figure out the markets by yourself. And honestly, what you learn in the markets now and apply it a year from now, hopefully when the markets are settled down, it's probably going to be a little bit different. And the ability to understand order flow in a few weeks versus never. So, other traders, Sheila was new to trading. She got my order flows trader software. She wrote this about it. My order flows traders, your order flows trader software is remarkably helpful because now I can clearly see what's really happening in the market. Like, for example, who's in control of the market on a very specific time and who's getting weaker as well. So who here agrees with me that now is the best time to start with order flow? There's the old saying, the best time to plant a tree was 20 years ago. Well, the second best time to plant a tree is today, right? So, ask yourself where you want to be a year from now. Ask yourself where you want to be when we come out of this coronavirus stuff. Um, so you got choices. Honestly, you could go at it alone, spend thousands and thousands of dollars figuring out order flow, how to understand the markets, get frustrated, and potentially waste years of your life, right? Or you could learn order flow from someone who has traded with it for over 20 years at some of the biggest trading firms in the world. When I was a kid, I used to collect baseball cards. Okay, this is how I like to describe order flow to people. And on the back of a baseball card, it would have basic information: your the players at bats, the number of hits, the second, the doubles, triples, the home runs, the RBIs, and his batting average, right? That's what most of us grew up, looking just at that information. Now you look at a baseball card, it's got all this other analytical stuff. It has obviously, the at bats, the hits, the home runs, um, doubles, triples, home runs, but now it's got, the slugging percentage, right? It's got the on base plus slugging percentage. It's got obviously their average, but it's got the wins above replacement. These are all advanced analytics, right? And because people are realizing that you can take this data what you're seeing here, and you can get other pieces of data out of it. Right? I don't want to get into baseball analytics here, but it's basically the difference between looking at a normal chart and a footprint chart, right? So if you're a beginner, you could learn order flow step by step and get software that's easy to use and understand the market with. If you are a veteran to trading, you'll be able to improve your trading by finding better entries and exits as you get a firmer grasp on what's happening in the markets right now. Now, as a special bonus, right, if you get this, I just decided this today, and again, after the special goes away, it's not going to be included, but I'm going to give you access to my order flow playbook, right? And it's a mini course. There's 10 trade setups in there that you can apply for your trading. You know, I've created several courses, but I find honestly the order flow playbook I think is my favorite. Okay, and again, to get started, go to orderflows.com/off2. I put the link in the chat there, and it's going to take you to this page. Okay, you can see I just updated this the other day, March 26th. There's a few videos. I think there's one or two videos on there. You know, introduction to order flows trading. Scroll down to the bottom of the page. Okay, takes you here. You can see the one-time payment, $675. You just click on the button. Okay, you could pay with PayPal, Visa, American Express, whatever, and it takes you to the page. It's processed by PayPal, right? So if you have a PayPal account, most people do, you can just enter your email or phone number there and click next. Or if you don't have an account, you can still pay with a debit or credit card by clicking on down here where it says pay with debit or credit card. So, you know, for those that have stuck around, I've gone a bit longer than, well, I didn't know how long I'd go. I thought I'd go about an hour. It's about an hour and 20 minutes. If you want my book, you know, the book that I started writing in 20, I don't want to say 2013 because that's the year I left JP Morgan and I had a 1-year non-compete clause where basically they said anything you do over the next year we got rights to. It started in 2014, Trading Order Flow. It's a 150-page book. Just go to orderflows.com/book.html, enter your name and email address, click submit. After you hit submit, it will take you to the download immediately. So it won't be sent to your email later. It will be available immediately after you hit submit. So I'm going to check, see if there's any questions first. Just give me a second. Let me just find my question area. Let me put that there for you guys. Let's see if questions. Let me expand this. Will it work with uptick, downtick data feeds like eSignal? No, it doesn't use uptick, downtick. It uses, it actually keeps the data in track. You know, NinjaTrader, they upgraded, when they made NinjaTrader 8, they upgraded the way data is handled. Before, in the past, you needed to basically keep your charts running so you'd have accurate data. Some people sort of got around it by using uptick, downtick, but we find for order flow, if you want the best available information, save the data, you know, you can get trading clouds, you know, VPNs for, you know, there's some that are like $60 a month or something. Get that, run your trading software on there, you know, because people always say, can I use the order flows trader on more than one computer? No, you can't because it's tied to NinjaTrader's machine ID on a specific machine. What I recommend is, as opposed to buying 2 copies, just get a VPS or a VPN, and you know, for $40 a month, $50 a month, put your trading software on there, and it will automatically run 24/7, and it'll have the data for you, right? And you can log in from your PC at home, you can log in your PC at work. If you go on the road, you go on a trip, you can still log into that. Okay, that's sort of the way of the future, I think, with computing. Let me see. Do not use NinjaTrader, use Thinkorswim and Schwab. Any suggestions? Yes. For people that don't want to use NinjaTrader brokerage, okay, if you trade futures, NinjaTrader now, they've in the past, up until I forgot what year it was, 2013 or something. They used to be able to use NinjaTrader with any broker out there, but then they changed the format and they made deals with certain brokerage firms. It's like NinjaTrader brokerage, obviously, when they started that up. Um, Interactive Broker, I think Gain or something, and a few others. This is very limited. What people do is they will get the software, they'll get the free version of NinjaTrader. It will run on the free version, and they just use the free version of NinjaTrader, but you do need a live quote feed. So the the simple way to do it is open a small account with NinjaTrader, to trade micros. You could put in $300 or something in there, but you'll get the data feed for like $15 as opposed to going out to like say Kinetic and getting a real-time feed. You'll be paying monthly, $150. So after 2 months, you're basically spending $300 that you can fund an account with. But you're going to trade the futures through your Thinkorswim platform or through your Schwab platform. Someone asked, can I get the book only? Yes, you can. Now, this package here, okay, these are the two bonuses and the order flow playbook. This package doesn't include the indicators. On my website, I have these 3 pieces plus 2 additional indicators on a different deal. That different deal is much more. It's almost double the price of this. It's $12.50. That includes 2 indicators, which those 2 indicators sell for a total of one's 500, one's 350, I think. So that's an additional $850 for those 2 indicators. But if you want to really get started using order flow and the indicator package that I have on my website will help you see things in the order flow that I didn't talk about today. There's many different setups in order flow that you can look at, but sometimes for some people having an indicator sort of helps them jumpstart their trading into order flow. But there's every trader is different. Some people like indicators to give them some help in identifying trading opportunities. But if you just want to learn the basics of order flow, get started with order flow, watching these courses plus the order flow playbook, learn a few setups, just look for those setups and go from there. I know a lot of people like to automate things because there are softwares out there like Pablo's markers, which you can automate some trading setups. That's fine. You can do that with my indicators. But I always like to tell people, especially now, for some people, they're a bit worried, this coronavirus, you don't know if you're going to have a job or not for some people, honestly. I'm not trying to sugarcoat it, but the whole thing is being able to get started, right? The worst thing you could do is not get started. So I tried to lower the barrier of entry for a lot of people. Now, if you get my software, and you want to add on the additional indicators are in the other package that's on the website, email me. I work with people all the time on special deals because I realize everybody is on a different level. Okay. I don't think someone asks, the link doesn't take you to the right page. You got to put book.html in it. Another question that comes up quite often is, can I use it on Forex or equities? Yeah, you can. Problem with Forex, but is the data is not, centralized the way futures are. So, you could be trading on a Forex platform and they're getting their date, basically it's probably a white label from Barclays, but the data feed that you're looking at versus the data feed that you're trading on can be different, right? Especially if you're getting it from, say, eSignal or Kinetic or IQ feed. You got to look at where the data signal is coming from. A lot of these forex brokers are basically white labels of a bank, okay? And their data might not be going into that data feed, or the data feed could be aggregated. The nice thing about futures is it's centralized. It comes from the exchange, right? And all the trades go through that exchange. It's not going through a particular bank or a particular brokerage company. Let's just go through a couple more questions. Will this work on TradeStation? Well, or Sierra charts, there's versions available. My software won't. It'll work on NinjaTrader. There are footprint charts available for those other software platforms. Pavel is interested in the flow trader indicator. I'll email you on that. That's a separate indicator. Manuel is asking about this order flow playbook. Find it here. This one. It's a course I came up with. I released last summer. It's a nice course. I said it's about 7 or 8 modules, but I talk about 8 or 10 different trading setups. Again, you got to know what to look for in the order flow. Otherwise, it's pointless to look at order flow. That's what I scratch my head with. A lot of people that trade on a dome, but they don't have the education, right? They don't know what to look for. So they say, well, spend 10,000 hours looking at a dome. Oh God, I'd bang my head against the wall because I've spent 10,000 hours. I've spent a lot more than 10,000 hours staring at a dome. And I tell you, it's, there's a lot more other things I'd rather do in life. And the problem with looking at something like a dome is, especially now in this day and age of, phones or something, you'll look away from a dome for 5 seconds and you miss everything. Okay, the nice thing about a footprint chart is the information is there for you. So, it gives you sort of a macro view of the order flow. Bloodhound, well, the footprint chart is not available with Bloodhound, but the indicators that I sell on my website are general. Um, so I don't like, will you answer email questions? I've sent you various emails in the past. I've never answered from an anonymous guy. I don't know. I've answered. I do get a lot of questions that I do answer, but let me see. There will be a recording, so yes. This is what drives me wild. This is sometimes someone will post something on my YouTube channel like a question, uh, but they'll say, "Hey, I sent you an email," but they're because sometimes, I got spam filters on my email sometimes, and honestly, sometimes people got some very strange emails. Big booty 62 is going to get filtered out. And if someone's posted on my YouTube, I sent you an email, and they don't put a clue into who's it's from, I'm not going to know. Because I do get emails that are go into the spam folder. I do try to go through the spam folder, but sometimes I miss things. Okay. So just bear that in mind. Manuel, I'm gonna try to give you a call this weekend. I've just been very busy these last few days. Um, so anyway, guys, what are the difference? Okay, just really quickly, um, pulse, turns, delta scope. I've got a bunch of indicators. I'll probably be launching a new website with indicators. Um, my programmer, he's also has a lot of work on his table because I give him a lot of stuff to program, especially in this downtime. Um, that my indicators don't overlap each other. So I have like the pulse and the turns, which come with the package that's available on my website, and the delta scalper, price rejector. Um, they look at different things in the order flow, right? I just showed you 5 different ways on this presentation to look at order flow. The pulse is something that tells you when aggressive activity is picking up. When somebody is coming in and potentially sweeping the market, either buying, lifting all the offers or hitting all the bids, or, basically buying it up through certain levels. The turns is a different one. The turns actually used to be a different indicator called the S&R levels. We've renamed it to the turns. Um, partly because the guy that originally did the turns or did the SNR levels was a different programmer than my regular programmer, and I made a few changes to it that, in my opinion, made it better. So I just decided to change the name to the turns because it's finding turning points in the market, right? It's finding areas where there's supportive volume or resistant selling in the market. So it's looking for um, basically turning points in the market. That's why it's called the turns. The Delta Scalper, I showed you earlier, the first thing I showed you on this presentation is basically the Delta Surge, which is you can download for free on my website. But the Delta Scalper is a different way to analyze Delta. It's looking for quick hits in the Delta based on the reading of current Delta versus Delta in the immediate past. So it's different. Price rejector is also different. It's looking for signs of price rejection at swing highs and swing lows, right? I showed you the small digit prints. That's a very particular thing in the order flow. That's just looking for prints. It's a simple thing, right? You don't need my software to look for small prints. If you have another company's software footprint chart, you can look for that. Okay, but the price rejector isn't based on that. It looks for price rejection by reading the order flow in the bar. So anyway, guys, I'll end it there for you guys right now. And again, thanks for spending your Saturday afternoon. It's a strange time that we're in, with the markets and obviously people's health. So stay healthy. Don't lick anything outside like you see these idiots doing out there. I don't know what goes through some people's heads, but again, stay healthy and stay active. At me, I've been doing some exercise. I find myself eating a lot more being on lockdown that I had to get the exercise bike and bring it inside the house to to start riding 10 miles a day at least. So anyway, guys, stay healthy, stay safe, and I'll catch you guys later. Thanks for spending your afternoon with me.